Hi everybody, thanks for joining me today. Over the years and through my experience, I've seen what I call the life cycle of traders and investors. So this goes from just entering the markets, a mom and pop, or somebody really young, not knowing too much, all the way to the most experienced investor. Hopefully this video will give you an idea where you are, what phase you're in, who to listen to, who not to listen to, what phases of the life cycle actually can add return, and which phases are really detrimental and can destroy a ton of value. Obviously, this is not a scientific experiment. This is just through my experience. I've interviewed some of the most experienced money managers out there. I've given them hundreds of millions of dollars of client assets, so I know their skills. I know their ego very well. I also have clients that are very much, mom and pop that don't know much about the markets and everything in between. So I have a pretty good grasp on what this life cycle of traders and investors might actually look like. So let's talk about the framework that we're going to go through here. So there's a few different things at play. So on the left-hand side, we have the vertical axis, which is simply going to be excess return. So you see 0%, that's your target, your benchmark, whatever that might be. That's not really important here, but whether you're going against the S&P 500 or you're just trying to beat cash or just make money, doesn't necessarily matter. This is very much like a personal target here. So just keep in mind on the left-hand side, the vertical axis, if you're high up on the scale, you have high excess return, you're beating your goals. If you're low, you have negative excess returns, you're losing to your goals. Then on the horizontal axis, we have what I consider experience. Now this could be called time or knowledge, very interchangeable in this context. And obviously, having more experience doesn't mean that you have more knowledge, or just because you're older doesn't make you more knowledgeable. That's obviously not necessarily true, but let's just assume that, for this. And it is pretty true for the average person as well. But what it comes down to is there's competing forces. So you have, obviously, your experience, your knowledge, but you also have what you think you know. So your ego, what you think your knowledge is, and what you can actually do, what your actual skill is, and they actually compete at different phases in the cycle. This actually leads into what I consider the 5 phases of a trader or investor. So let's jump right in to phase 1. These are the rookies. So think somebody that just entered the market, very inexperienced, mom and pop, somebody very young. Doesn't necessarily matter here, but the key is they know that they don't know, but they don't really know what to do. So the way to think about this would be, say somebody that has some money to spare, they eat at Chipotle every day, they love the burritos, they want to invest there. They know that they're not very skilled, that they don't really know much about the markets, but they're kind of dangerous because of the fact that they don't really know what to do. So they can really hurt you in terms of excess return. And that's what you see in this red line here in phase 1 at the very beginning, low experience. It's really detrimental because you see people that, invest in places they shop at or eat at, or they leave their entire retirement account in the company that they worked at, or they put all their money in XRP or Ripple, whatever it might be, that's what they do. But as the rookies gain more experience, something actually very interesting happens. They actually recognize that they don't know very much. So their level of ego or confidence actually goes down because they're actually getting more knowledgeable and they're realizing that they don't know that much. So that's why you see that blue line decreasing. But at the same time, you actually see the red line increasing. So as they actually become less knowledgeable, or that's not the right way to put it, as they realize that they're less knowledgeable, their excess return gets closer to 0. Why? Because they're entering phase 2. Phase 2 are the indexers. They know they don't know, so they index. Now, the reality is not every single person is going to go phase 1, phase 2, all the way through to phase 5. Some people might skip phase 2. They just might not ever index. or they might skip another phase. This is very much just what I've seen for the average person. But just keep that in mind. So what does index mean? That means they know they can't beat the S&P 500. They have enough experience that they know they can't do it, and they know they have a very low ego, so that they're not very confident in being able to beat it, but they know enough that they can go out and buy an S&P 500 ETF. They can go out and buy a basket of stocks or a basket of cryptocurrencies or whatever it might be, and basically get the market return, which is actually not bad. They're actually doing pretty well given their level of experience and how much they think they actually do know. So what happens after phase 2? So as you can see here, the blue line is increasing. So as experience and time passes, their ego actually begins to go up. So they actually begin to think that they actually know something. And that leads to phase 3. I call these guys the destroyers. Now there's 3 phases within phase 3, which I'll get to. But the destroyers, they know enough to seem knowledgeable, so they're kind of trustworthy. They know enough to want to try it out for themselves. They know enough to be arrogant, but they don't know enough to know they don't actually know. So they're kind of in between. They kind of have an idea of what's going on, but they're not really truly experienced. So these are the people that might backtest a particular strategy that worked 50 years ago, and they think it works pretty well today, so they pile all their money into it. So they're very highly confident, but they're not as sophisticated as you really need to be in 2018. So in phase 3A, I call these guys, they're basically just a nuisance. They're pretty harmless. They have a slight ego here. They're hurting their own portfolio, but they're not really hurting anybody else. Generally, they might still be indexing, but buying a few stocks here and there, or a few cryptocurrencies here and there, to add a little extra alpha, but generally they don't do so because they don't really have a rock solid 2018 or 2019 investment philosophy or strategy that works. Phase 3B is really bad. I call these guys the influencers. This is peak danger, peak arrogance, peak confidence. They still don't really know much. They're still using ancient investment strategies, if they're even using an investment strategy at all, and people trust them. You can almost think YouTube personalities here, even though I'm broadcasting this on YouTube, but I can name a couple easily on YouTube that fall in this category. They don't really know what they're doing. They have a huge following. They can cause huge danger, and they crush returns in the long run. Phase 3C, I'm calling this El Capitan. So these are the guys that they're not just like peak influencers anymore. They're not just trying to work that angle, but they still have a ton of arrogance. They still detract from returns. And these are the guys, generally, you might see them post a picture or something on Instagram or Twitter, Photoshop them on a yacht or something like that, where they think they're, top dog, but they're really not. They really don't know enough to be adding excess return. In many cases, they don't even know what true excess return is at this stage. Then we get to phase 4. So this is actually the phase where people can truly begin to add excess return. I call these the true alphas. These guys are actually humble enough to know they don't know everything. That's why that blue line has come down. They recognize the markets are really tough, very hard to beat. There's a lot of stuff that even the smartest people in the markets just simply won't ever know. And it's really, really darn competitive. So they don't think they can add a ton of return, but they have a ton of experience. They know how to build investment strategies, and they can actually add a little bit of excess return. Their ego pretty much matches their skill. Now, the reality is there's not that many people here. So even though I marked this out in 5 phases, we're on phase 4, and people do bounce around, like I said before. But the reality is phase 4 alphas are a very small percent of people out there. Think some of your big investment managers, think some of your greatest traders out there, pretty low. Whether that's 5% of people, if not less, would fall in this category. The vast majority of people that don't even know anything about the markets obviously would fall in phase 1. But once you actually start dabbling in the markets, a lot of people, especially in equities, end up in phase 2, and they just stay in phase 2 as an indexer. Phase 3 is really dangerous. It's not a ton of people there, but you see that much more in the Twitter community, Reddit, things like that, or YouTube, where they're actually trying to sell something, paid groups, whatever it is. Of course, alphas can have paid groups too, but generally their arrogance are much lower for the alphas, so that doesn't sell as well compared to the destroyers. But once you get to phase 3 and 4, there's not as many people here. So you're maybe talking 5% of alphas, 10, 15, 20% that would fall into phase 3. So what about phase 5? These unicorns, magic. Very, very rare here. You have huge ego and huge excess return here. They think they can kick butt, and they actually do kick butt. Hopefully you didn't believe any of that, because if you actually did believe that, you're really in phase 5, which is the Madoff. So where you actually have a huge ego and they're scamming you and you're crashing and you lose pretty much everything. The reality is the unicorn does not exist. Generally, if ego gets to this point, something is going to break. And generally, it's risk management, because these guys went through phase 4 into phase 5. Even think Bernie Madoff. So somebody that has a lot of experience, knows how to build investment strategies, knows how to add excess return. But these guys fail generally due to risk management. They get in way over their head and things end up just crashing and burning. So the difference between phase 5 Madoffs versus phase 3 to destroyers, I consider phase 3 to destroyers, they don't know enough to actually build a good investment strategy, but they're generally disciplined, potentially disciplined enough to follow it. Phase 5 the Madoffs, these guys know how to build investment strategy, but something just happens and they just blow up spectacularly. So keep that in mind. If it's too good to be true, it almost certainly is. So that ends up being the life cycle here. You got phase 1, the rookies, leading into phase 2, the indexers, where these guys still don't know that much. They know they don't know that much, but they know enough to index and get market return. So then you enter phase 3, the destroyers, where ego goes up. They think they actually know what the heck they're doing, but they really don't. And they can have peak danger, peak social presence, and really hurt a lot of people. Leading into phase 4, alphas, where the ego comes down and they can actually add some excess return. And the danger would be the alphas, for whatever reason, they just get the big ego, get a lot of money under management, whatever it might be. They get in over their head and they turn into the Madoff. Very few people reach phase 5, obviously. The vast majority are going to be in phase 1, phase 2, with a little bit in phase 3, even less in phase 4, and a very small amount in phase 5. But you got to be cautious of who you're talking to. And if you're getting advice, which most people here are not licensed to give advice, you need to recognize who you're getting advice from, who you're getting your knowledge from. If it's somebody in phase 3, that's really freaking dangerous. So you want to be getting your knowledge in phase 4. But those guys are generally not the guys that have the high ego or the high arrogance, so they don't seem like the guys you want to get your knowledge from. You want to get the guy that's living large on a yacht. But those are generally the most dangerous people to get knowledge from. And obviously keep in mind, you don't want to fall for a Madoff. Remember the unicorn. If it's too good to be true, it actually is. It's going to fail big time. So that wraps up the life cycle of traders, investors. So let's talk about some of the good news here. If you're watching this, you're probably not a rookie. Hopefully you've led into an index type person, or you're relying on or investing money with somebody that's an alpha. That's the beauty of the capital markets, is you don't have to be an alpha to get alpha type returns. You just have to invest your money with somebody that is an alpha through a mutual fund or whatever it might be, a hedge fund. But if you like this video here, please comment below. Follow me on Twitter at CryptoQF. You subscribe to this YouTube channel and comment, please. Have you ever been screwed over by a destroyer, whether it's a paid group, just listening to what they have to say? Do you believe in unicorns? Or there's some people that really have the max ego that can really deliver that excess return? I actually don't. Just in my travels, even the best investors out there are a lot more humble than what you actually think. They recognize the markets are very complex and very difficult to beat. However, you've seen a lot of papers out there and a lot of research and just conversations around the water cooler that say alphas don't even exist, that you're so much better off just being an indexer. What do you think? Can you find an alpha? Can you actually get excess return? or should you just jump in and just be an indexer? And last but not least, what phase do you think you are in? Are you an actual destroyer? That doesn't mean that you're trying to scam people, but do you think your ego is bigger than what you can actually deliver? Then you might be in that phase 3. It doesn't mean you're a bad person or anything, it just means your ego outstrips your ability. Are you an alpha, where your ego comes down, kind of more laid back, but you can actually add some excess return, you understand the markets, and you can build a real investment strategy? Are you an indexer? Or did you just enter the capital markets and you're a rookie? You don't really know what's going on. You don't even know what you don't know. And God forbid, are you Bernie Madoff? If you are, you probably don't want to comment. So that wraps up this video. Obviously, if you like it, click the thumbs up, subscribe here, Crypto Quantamental, and follow me on Twitter at CryptoQF. I'd love to hear your comments, see your comments, and have a great New Year. This is obviously December 31st here, 2018. So we're jumping into the new year. That's trade safe in 2019, and riches for everybody, hopefully. Thank you.